Which sectors or themes do you think will drive us to become the $5 trillion economy?
Two parts to every driving economy. One is the core. If you see banking is a big part of your core, 37% of Nifty 50 is banking actually.
Reserve banks across the world are increasing their allocation to gold. What's your view? Is the world order changing?
On 10 years, if gold is outperforming basic equity market broad indices, then it's time to think.
So if we are to move from an era of the dollar hegemony to de-dollarisation, how should investors be prepared for it, if at all?
Some of the trends do suggest that the dollar is not what it used to be. In some countries, especially China.
Today, we have Mr. Swarup Mohanty with us. He is the CEO and Vice Chairman of Mirae AMC. He has close to 3 decades of experience in the financial services space. He joined Mirae 14 years back as the Head of Sales and rose to the ranks of CEO and Vice Chairman. Before joining Mirae, he has worked with Relicare, Birla Sun Life, Franklin Templeton, and other AMCs like Kotak Mutual Fund, Tata Finance. Today, Mirae manages over 2 lakh crore rupees of assets of people in India. Let's hear it from him.
Hi Swarup, welcome to our show Speaking with Stalwarts. It's a pleasure to have you.
Thank you, Kanan. Pleasure is all mine. Thank you for doing this with us.
Great. So to begin with the first question, where do you come from and how did you rise to the ranks of a CEO and Vice Chairman of a global asset management arm of a company like Mirae Asset?
How much time do you have? Because it's a very long story. It started, I think, in the mid-80s. I belong to Bhubaneswar, city of temples as they call. My parents are both professors. I come from a family of education. They're all doctorates. My wife is also a doctorate. So I'm the odd man out in the entire family. My son is also an engineer. So the education part belongs there. I'm the one who's not as educated as them. But when we were growing up, I think something very, very spectacular happened in India. In the mid-80s, India liberalized. So the traditional career paths that were there in our times, which were either the civil services, the doctors, or the engineers, were something which, many of us started thinking whether there's a world outside that. As a result, I then started studying on the commerce side or the business side and started looking for a career on this side, and that one led to the other. And from Bhubaneswar, I came to Delhi to study, started working a bit in Delhi, started in the non-banking finance side, and then slowly but surely, mutual funds happened towards the end of the 90s, and I used to work in Calcutta then. And then retail mutual funds happened to me, and then slowly but surely, I realized that this was the career path and the product that I identified very closely with. Because mutual funds, one of those very few investment vehicles which rightfully shifts the risk of investment back to the investor. Finally, it's our risk and we should bear it, right? And that is why it will prevail, was my view. And I backed myself to build a career in mutual funds. And from Delhi, I came to Mumbai. And here I am sitting in front of you. It's my 15th year with Mirae Asset. And then we're trying to build a good platform for ourselves in India. One thing that always strikes me for the job I do, it's a fiduciary responsibility. Our career is based on somebody else's money, and very, very fortunate to be sitting on these chairs. So to uphold the fiduciary responsibility is what I strive for, and I think was very humbled when I was bestowed upon the designation of vice chairman in a Korean organization. I think I'm the first non-Korean to be one, so that was very humbling, and I can never thank my organization for that. And that puts a huge amount of responsibility on me, and I'll work harder to kind of do good to that responsibility.
So coming to the question that is concerning all of the investor community, the US has imposed 50% tariffs on Indian goods exported to their country from our side. And India's total exports to US account for around 20%. Do you think that when the impact is visible, we are going to see a mayhem in the markets?
See, I think the tariffs is not something only for our country, but it's across the world. Some are getting a higher one, like us. Some are getting a lower one, right? There is no denying the fact that when a country of that stature changes its behavior, the world is going to change its behavior too. The question I'm asking myself is, are we in the midst of history being created? Are we going to see the world order changing permanently from here on? And are we going to be fortunate enough to see that happening during our lifetime? It's possible, right? While there is a secular recognition of the fact that India, not only being the largest democracy of the world, is a growth engine of the world too. I mean, for a change, Indian growth is now impacting global growth. And that's where we are. We are poised to be the third largest economy of the world. And trust me, because of the demography that we sit in, the fact that individual Indians are creating wealth on a yearly basis, on a daily basis practically, and India is not exactly the poor country that it used to be, say, a decade ago, is just a hotbed for opportunities, not only for US, but for every country. From our side, we have to be a little unemotional as we speak. This is my personal opinion, because if we can sell to one country, we can sell to others. We have not imposed the tariffs, they have. And if it is real, because the devil lies in the details, and right now it's a lot of discussion on Twitter rather than a signature being done. I think once the signature is done, then we will know where we stand. Then if you see, typically there are 2-3 large industries which are impacted. And those, I'm sure the powers to be will come to handhold them, not only handhold them for the near-term pain, but we'll find other buyers for them. See, our product is good. If our product were not good, US would not be buying them, right? And our product, in dollar terms, is not very large. To shift from there to another country, and I'm sure the diplomacy would be already working on that, would take some time, but would not take a lot of time. So yes, in the near term, how these industries are handled will be worth watching. And I'm sure, I think as a power, we are capable of handling that. Some impact in the near term, but in the long term, will relationships change? Will trade change? And are we going to charter that change? Because the focus is on India globally. There are more people in the US in support of India than what we had seen earlier. And that's so fantastic. So see, just speaks of the potential that we are now in the world.
How do you read the latest GDP numbers? Is the valuation premium that we have in the markets justified with a 7.8% growth?
See, I'll address it two sides. I mean, let's keep the valuation aside for a second. Yes, 7.5 was a good, pleasant surprise. We need to grow at that rate, right? We cannot fall between 6.5, 6. 6 is the bare minimum that we have to grow to fulfill our own targets, right? At 6, we are a little behind, but I think if we are headed to becoming a 5 trillion, 10 trillion economy, in our own selfish interest, we have to grow at 6.5, 7. Yes, 7.5 was a good thing to hear. Can we sustain it is the question, right? If we sustain it, it will be fantastic, because that's a good growth rate. I suspect it will be between 6, 6.5 is the average that will grow at, which at that time also will be in relative terms growing far faster than a lot of our peers, including large economies like US and China. It keeps us in good stead. Valuation is a different story. India was never available cheap, and I dare say will never be available cheap. You will buy this product always as a premium. As a result, some might prefer to buy it at some point of time. Some people may not prefer to buy it at some point of time. But what is happening, and that's something which has really come to the rescue of the market. I use the word rescue because some people think that we can live without FIs. I am not of that camp. I think we need those large monies for our market cap and our market to grow. But the fact that retail penetration is happening thanks to people like you, people are moving more to financial assets over fixed assets and are taking to capital markets far more than they did, say, before COVID, is building this ownership of our own markets and taking a very different shape to that ownership. And that is helping this market, and there's no doubt or debate on that. The fact that the SIP book is of a certain size and is now growing monthly is a big backbone to the market. So if there is a buyer in place, now price is where the buyer and the seller meet. If there are buyers ready, the price will always be pegged at a certain level. Is my pure mathematics, right? So I don't think valuations will be exactly cheap. In some pockets, I dare say they will be far more overvalued than they should be. So those are areas which one has to always look out, and that's where the balloons come in. If you look at the market between last year and this year, it's completely done a U-turn. And then when you catch those balloons, that's where you should be a little afraid of. But broad market is in a good shape, is what our house view is.
The experts are divided on whether the deflator should be higher. The difference between nominal GDP and the real GDP is just 1%. Do you think we should have a higher deflator to account for inflation? Because the difference was just 1% this time.
I mean, there is a debate on that. I am not a lawmaker, to be very honest. There are two types of people, the lawmaker and the law follower. I am a law follower, so I'll go by what the policy making happens. There are two sides to every story, and if something has been working for some, I'll let it be. I'm not a big fan of tinkering with too much of data.
Which sectors or themes do you think will drive us to become the $5 trillion economy or the $10 trillion economy?
There are two parts to every driving economy. One is the core, and I'm a big fan of the core, always, because if the core falters, your broad numbers don't come into place. And there, if you see the core of India, the pillars primarily are, if you see banking is a big part of your core, 37% of Nifty 50 is banking actually. So your banking needs to do well. And to be fair, post-COVID, that's seen a very different shape in the form of digitization. So we've only built on banking as a country. So that will continue to expand. I think my personal favorite always remains healthcare, because India has so much to do in healthcare, and that's something which will perpetually grow. I mean, I've said this wherever you see me. So the core of healthcare is something which will drive the country, and healthcare penetration is just about started. Please understand, it is directly linked to the penetration of health insurance. And with the government putting the health insurance on the table, it is set to take a very different turn going forward. Tariffs without tariffs, right? I think the one which one has to look out for the future, and I think we are building up for it. If I were to give the next 15-year core theme, would be manufacturing for me. And please don't compare our manufacturing versus global manufacturing. Let's compare our base to what it can become.
Right.
And our low base will help us in that. And some green shoots in various areas are beginning to showcase. If 20 out of 100 iPhones are now being made in India, it just showcases that we have the potential. Here's the only caveat. I think we need much more foreign money to build this manufacturing dream of ours than we currently are factoring in for. I don't think Indian money can propel it as much as it can. So the need for FDI for India is paramount. This is my submission from a manufacturing perspective. But yes, on the ancillary, I think finally we are seeing infrastructure now beginning to take a corporatized vision. So we will see infrastructure taking a very different turn. Earlier, if you see from our industry perspective, it's been one broad theme which has flattered to deceive. It has promised a lot but has not delivered as much. But I think the story can be very different in the next 10 years. I think what we are looking for on the other side are very interesting themes for the future building up. I think EV is something which we have to look at. That entire environment called EV energy, I think, is something which is building up very well. We are not big fans of defense India, but defense global is something post-US is something which we are a big fan. That's the house view of where I said global defense globally. But yes, if we were to mix the two, a lot can happen. I'm a big fan of within banking and finance capital markets. I think that's an area which will unfold very, very largely in the next 5-10 years to come.
Got it. So which are the sectors that you at Mirae are banking on for the next leg of growth?
No, I think our house view has always been banking and healthcare. If you see broadly, we've backed that for the last 15-16 years. We are big fans of these new things emerging of EV, energy. So that we've gone out and done something very constructive on both active and passive side on that. But I think when you look at the structure of the market, something very special has happened over the last 3-4 years, and that's for all of us to understand, and what I would term as the democratization of the market. One, if you look at the public issuances that have happened over the last 2-3 years, and I think India was the largest public issuance market last year. Most of the public issues are in the mid and small. So when you look at portfolio construction, the erstwhile proverbial thumb rule of 70-30 or 60-40 towards large cap needs to be relooked, because the number of quality industries that have come up, let's look at asset management, hospitals, I can go on, chemicals, are all in mid and small, own the same length and breadth of the market. Your approach to allocation, I feel, needs to be relooked a bit at this moment. Why market? I mean, the person who bought gold and sat on it quietly actually is earning more market than the equity market. So it's a good time to reflect on 2-3 things. Is the world order changing? If it is changing, then a lot will impact us. Secondly, due to the democratization of the market, your approach to asset allocation in the form of market cap also needs to have a relook. And third, most important part, as India starts developing these new areas of work from manufacturing to, say, energy, some of these stories need to come into the portfolio.
Got it. Since you spoke of world order changing, as reserve banks across the world are increasing their allocation to gold, right? And as we see, gold has been rising like anything in the last 2 to 5 years. What's your view? Is the world order changing?
I firmly believe it is, and I tweeted about it today morning. Should asset allocation go by the earlier rules? Because the proverbial rule is it is a hedge. On 10 years, if gold is outperforming basic equity market broad indices, then it's time to think, is it a hedge or is it an actual serious investment route? I mean, you cannot not allocate to it seriously anymore. I'll probably put gold and silver together. What you allocate is up to you as per your risk profile. But these markets are very serious, and if a sovereign for the first time now, gold reserves are higher than the dollar, then yes, it's changed. You cannot deny that anymore. And I think it's time to look at it beyond that term called hedge.
So if we were to move from an era of the dollar hegemony to de-dollarization, how should investors be prepared for it, if at all?
I think very early to say whether we can de-dollarize it. I think in 2008, Warren Buffett made it very simple for me, saying that the world trades in dollars. Okay. But for that to happen, the world order has to change dramatically. Yet, some of the trends do suggest that the dollar is not what it used to be. And some countries, especially China, with their currency, have been making an impact on the world trade as we speak. But for dollar to go, it's too early to, even think of discussing. But that said, it is time to not be biased towards asset allocation. My unlearning over the last 3-4 years is this huge mathematics on a multi-asset structure, right? Your probability of earning the median return is actually higher in a triple asset structure than a pure one asset structure. And that's something which a person like me, who was very biased towards, say, equity as an asset class, is beginning to learn, or my earlier bias is beginning to get unlearned. So the virtues of asset allocation should not be only in thought and print or on Twitter, as I say it. It should start now percolating into your portfolios. One, you have to move towards financial assets and then start owning all asset classes on the merit of your risk profile. You cannot be zero on any one side. It is how you have to approach this.
The success stories in the AMC industry have largely been written by the arms of, big private banks or even the public banks. However, it has been seen that it has been very tough for any foreign player to come in and, acquire a good share in this market. And many big asset managers have tried doing so. What sets Mirae apart from other companies?
Yeah, it's uncanny when we ourselves keep repeating it to ourselves to believe the statement that we are the only global organic asset manager in India. I mean, there's nobody who's alone in India, and it's survived 15, 16 years. That's how tough it's been for global asset managers, right? But yeah, I think it has to start with the promoter, and that's where I give a lot of credit to not only Mirae Asset as a house, but especially to our owner chairman, Mr. Hyunju Park. I mean, he's been singularly bullish on India since 2006. Sometimes I wonder what is he seeing that I am not able to see. He is so singular in his view towards this country. I mean, 2 years ago, and I got this great fortune of narrating that story to the Prime Minister of this country, that I was in a room of 200 people. There were 199 Koreans in that room. And suddenly I heard him saying that in this entire global turmoil of the world, only one country will benefit, and that is India. To single out one country just speaks of his conviction on the growth. And he's a fund manager, so he has his data behind him. So in 2006, when he came in, or when Mirae Asset came in, they came with a singular view of being in India perpetually. In my interview in 2011, I was told that, we are emerging market experts. That's our tagline. By virtue of that tagline, that one dot in Mumbai we will perpetually have. Whether we are 1 dot or 50 dots, up to you and your team. But that's how high our conviction on India is and we are businessmen. There's no emotions. It is backed by proper growth data. And to be fair, I think the country has done justice to that conviction. I think the second most important part is to localize business. You might be a Korean headquartered, but in India, you have to be an Indian. If you try to be Korean in India, more often than not, you will fail. And that's something which we are very happy with, because I think India was the first, if I'm not wrong, was the first global arm of Mirae Asset, which was handed over to a local leadership, right? And once you have trust and faith and you are given time, a professional will definitely deliver, is my opinion, right? Invariably, the first two are not there. If trust is there, time is not there. If time is there, probably trust wavers, right? But we had both. And we are always capitalized extensively. We believe that our money in this country will grow. And most important, as professionals in the team, I think we work within the law. You've not seen us deviating from the law at all. It's a fiduciary business. We've upheld that. We've kept the product the center stage. Sometimes we've agreed with the market. When we've not agreed with the market, we've not shied away from staying out of it and taken a bit of underperformance. So we are a team which keeps fund management at the center, because that's this business. And from there on, if you see, Mirae Asset globally is this classic story of a long-only equity scheme. This was the first mutual fund of Korea, now becoming a global investor. We've taken that as the blueprint of our business, and we started as a mutual fund in India. But today, from mutual fund to venture capital, mutual fund both on active and passive side, we run a very successful NBFC business now. We have one stockbroking on our side, on our own. We just acquired Sher Khan, which is one of the oldest stockbroking firms of India. We run an investment banking outfit too. We have a very interesting indexing business in Gurgaon. The point I'm making is, in that same blueprint, slowly but surely our businesses in India are expanding. And my humble request, you can Google all this, please check the capitalization of each business and you will see how much we are invested in India as an entity.
That's great. That's great. So, speaking of actively managed funds, our study, our research shows that apart from small caps as a category, all actively managed equity funds have, like, more than 50% of actively managed equity funds have failed to outperform their respective benchmarks. What processes do you set at Mirae to overcome this challenge and break the benchmark barrier?
I think two factors to this. This is not just an India phenomenon. This is a global phenomenon. As market starts becoming transparent and more information is given out in the market, there is very little that is left between the analyst team and an average person on the street on information. Finally, price discovery happens if the information is sacrosanct to a few people, right? Only few people are privileged of having certain information, and hence they get in a little early. That will start narrowing as the transparency starts growing. And India is on that journey. But I talked about the democratization of the market. If you look at the last 2-3 years, see, I'm not selling this fund, I'm just giving an example. In 2016, when we closed our flagship fund, then called Mirae Asset Emerging Blue Chip, it was mid-cap fund then, we closed it because the flows were such we didn't have enough stock ideas to invest in. But that is not so today because of the public issuances. As the number of public issuances grow in the market, the story of active fund management remains actually kicking, right? It's actually gave them a breath of fresh air the last 2-3 years. If public issuances wouldn't have happened, this story would have taken a very different turn, right? But the asset management space is now developing very well. There is the active business. 50% is not bad actually. Globally, it's at a different level of underperformance. But I think because of the public issuances, some of these stocks beginning to unfold their valuation, you will see a very different data. This is my opinion. I think the industry today has enough talented data to give out performance over the index. Having said that, when you look at the categorization of funds, there are that many fund categories or funds that a fund house can launch. This is a business of ideation, right? New idea is curtailed on the active side. But on the passive side, wherever there is an investable universe, I can create an index. And hence the ideation is unlimited on the passive side. And that is true not only in India, globally. Hence you see a plethora of ideas always coming from the passive side. And I dare say that will also happen in India. Globally, 7 or 8 passives are launched on a day. And since the ideation will happen there, and trust me when I say this, the young look for ideas. My son is not going to invest in a flexi cap. My son will probably more be inclined to invest on the EV side. Probably they understand it better. For sure they understand it better. So I think when you look at investing and the Indian demography being so young, this ideation will propel a very different set of investors because their risk profile is also very different. So you have the active side getting a fresh breath of fresh air. You have the passive side now beginning to get its act order in place of the ideas they had floated. I think just wait for the time when the factors which many funds had written, once their track record starts building, I as a manufacturer, because I'm a neutral guy, right? Very interesting to see active versus factors in the next 5-10 years, right? Asset allocation happens at the investor's end or at distributor's end. Our job is to develop a product on both sides. I think the SIF can also add a very, very interesting, I think, angle to investing or take investing to a different level. So asset management is a good space to be in India. And I think all spaces are alive. All spaces have merit.
But speaking of passive funds only, we have seen a very rapid shift in terms of index fund folios, investors increasing in the last 5 years, especially in the last 5 years. They've grown multifold, 5x, 10x in terms of AUMs and folios. How at Mirae are you looking at this transition? Are you also launching new and new passive funds, and are you bullish on this space as a category?
Yeah, extremely. I think, as a manufacturer, you have to be in that space. You don't have forget being on a choice because the prospects are looking so good on that side. Please understand, India is the only country where the demat accounts are double the size of the mutual fund folios. So naturally, we are an ETF player. We are not that big an index player yet. Maybe we'll review it as the years go because we are big fans of ETF. It's a real-time product, right? And that's what is so exciting about that side. And because of the ideation backend, I think we have some 24 odd stories already in the market. Out of which 14 are homegrown. We've created these indices. And we back ourselves on creating good products. I think we have one of the best product teams in the market. Our EV is product we are the only mid and small in the market. Our small cap factor is very differentiated. I think some of the insurance companies have started copying our index. But yeah, it's great to do that business primarily on two sides. One, as you rightly said, the folios on the passive side was 2% of the industry in the last 5 years or 4 years ago. Today 17%. So incremental flows are happening there. The demography is getting younger. It is set to grow further with the digitization of this industry. No wonder people are opening more demat accounts than they did earlier. So this premise of telling people that you have to open a demat account is actually now flawed at a fundamental level. You can open a demat account in 3 or 4 minutes, right? So that is where this is going. But the key is to develop products and build track record on merit on both sides. On the active side, bulk of your product should outperform the benchmark. And because of the transparency of the market, my learning over the last 2-3 years is this horizon on which you will judge fund managers' outperformance of indices has to be a little longer.
Got it.
It cannot be a year or two. In a year or two, even the best will fail.
Got it.
Because when there is a secular buying, index will win. It is very difficult to beat the index when secular buying.
We are seeing that space of secular buying right now.
You have to increase your horizon to test fund managers. Otherwise, what will happen? The investor might lose patience and leave a great fund manager just before he or she were about to perform.
Okay.
I can give a number of examples, non-Mirae examples. I can give Mirae examples also. But you have to continue the journey with your fund manager. And at this moment, I would say 3 years is a good time to judge a manager. After that, start forming. And then also for the next 1-2 years, don't conclude your is where this is going, right or wrong. I don't want to get into that debate, but this is where it is going. But if you are on the active side, you should aspire to beat the benchmark. If you are on the passive side, your tracking error should be the best in the industry. But more important, when you launch a product, you should be confident of providing liquidity for your products in the market. The passive side or the ETF side is more liquidity oriented or a capital market product than just the product itself. For me, the great unlearning was running the active side is actually more passive than running the passive side, which is extremely active. It's not easy to do that business at all because the environment has to be created for that product. But you have to, as a manufacturer, be cognizant of the merit of each product and then build it accordingly.
Got it. Now coming back to the sectoral and thematic debate, our research shows that in a 3-year period, whichever funds rank in the top 10 list fail to even, land in the top 100 in terms of performance. I'm talking about actively managed equity funds. So this is largely due to sectoral and thematic funds where they perform in a cycle and they extremely underperform in another 3-year period, right? Which is not the case with broad-based with the funds that are investing on a broad-based index basis, right? So should investors be allocating a large sum of their money of their portfolios to these kind of funds?
To see, first of all, one needs to differentiate between what is a sector and what is a theme. A sector is a subset of a theme. I'll give you my most favorite example is when I started working in the late 90s, our fact sheets read banks. There are banks and NBFCs. Then it was bank, NBFCs, financials. Now it is bank, NBFC, financials, fintech. When we launched consumption 15-16 years ago, it was primarily FMCG. Today, consumption is a diversified portfolio. When we launched healthcare 5 years ago, it was primarily pharma. But healthcare now is beginning to now get into every part of your life. Just fitness itself can be an ETF, let me tell you, right? So, be very careful when you select sectors, because sectors can be extremely cyclical, can be in favor, need not be in favor for a long period of time. But when you look at themes only grow over a period of time. Our global ETF brand is called Global X. Their social media fund was before Facebook. The lithium fund is in its 10th or 11th year. And now the world is talking about lithium, right? So themes will grow. To every viewer, I would really request one thing. Pick up any consumption fund that they want to pick up of the market. Compare that to a core fund, whether it's a flex cap or whatever, on all parameters, on all ratios. See the balance sheet sizes that portfolio has. And then come to a conclusion on risk reward. The answer will be there. So, again, coming back to my first submission, don't be biased. How much in proportion you want is a factor of your risk profile, but you cannot not have themes in your portfolio.
Speaking of the gift city funds, there have been funds being launched by AMCs with a minimum ticket size of $5,000 for retail investors. Do you think retail investors should invest in such funds? Because considering the redemption pressure that comes in, if it comes, then a 42% tax might get triggered at the fund level if the redemption happens within 2 years.
See, when a manufacturer launches a fund, the risk profile of the fund is the responsibility of the fund house, right? Let me give you something in broad perspective. And again, I can only share my data. See, out of the 2,15,000 odd crores that we manage, our largest distributor will be around 5,500 crores. Our largest client will be 3,500 crores. This is split over 72 lakh folios. Out of it, only 3 lakh folios have over 10 lakh of AUM per folio. The point I'm making is when you're building a fund, more than the returns, the de-risking of the fund at an investor level is also very sacrosanct for the manufacturer. No wonder there is the 2025 law which is applicable to mutual funds. We are debating whether that's applicable at these sizes anymore. But yes, at a construction level, every fund house should be cognizant of the risk that you are putting up.
Got it.
At any point of time, in our earlier days, we used to carry it, but now the portfolios are so diversified that we don't. Every salesperson in my team used to be pointed out the risk metrics of his distribution holding. If one distributor was holding a little bit more, he or she would be pointed out to develop other distributors. To de-risk the business every day is our job. But what you're saying is can happen. So when you choose a fund, it's not just about returns. Some of this you can ask your advisor distributor. A fund should be able to disclose this very transparently too, but at no point of time, see, at every day, there are 4 investors in a fund. One who is coming in, one who is going out, one who is there, and one who is not there. These are 4 investors. At all points of time, the fiduciary responsibility of an asset manager should do justice to each one of them. One cannot sacrifice one for the other. If it is run like that, no investor will have an issue.
So, since investors will be able to invest in overseas market through these kind of routes, do you think the RBI should enhance the limit for the mutual fund industry to invest in overseas assets?
Yeah, I'm a big fan of global investing. India is just 3% of world market cap, and there are businesses outside which are not in India. So, and we come from South Korea where global investing is a reality, right? And they've actually benefited at a portfolio level. Of course, the central bank would have its own reasons for not doing this, but in fairness to investors' opportunities, they should be given this opportunity, in my opinion. But like I said, I'm a law follower. I'll abide by the law and patiently wait for the opportunity. But there's some fantastic stories developing globally, and Indians should be allowed to own those stories.
Of course, they are being allowed through either through AIF route or, through these kind of retail funds, but they're still like at least $5,000 limit, which is close to again 4.5 lakh rupees. But for smaller investors who cannot invest one, so much of sum in one fund, why do you think the RBI is not enhancing this limit?
It's beyond my pay grade, honestly. But mutual fund is that product through which it should be allowed.
What are some interesting things that you're doing at the technology front to build your business at Mirae AMC?
I think the first cognizance of the fact that AI is a reality is something which came to us a year or 2 ago. So we have a good AI team working at the back end. We are rehashing every department, every function as we speak, trying to clean up data to create a good data lake for ourselves for each function. People talk about fund management. Yes, fund management is a key area of working because see, what's happened is slowly but surely the world of analytics is moving to fetch. Analysis is already done. You have to just fetch it out, right? When you ask Google, it's not going to tell you how they're going to find that route. It just gives you that route. And that is true for every function that we are in. In that fetch world, how do you create the backend is the challenge, right? And the other challenge for every person in this world is once what you used to do in 8-10 days can be done in 5 minutes. what do you do for the rest of the time? It increases your productivity, right? So can we at one point give an assistant to each analyst of ours to fetch whatever he or she wants, to building a complete machine run AI fund, AI, not an algo, AI fund, to be able to judge the sensitivity of a person's email because of some words which he or she has used in a particular email, which was not normally used in their previous, so which will help us service the person better. Everything is being discussed, talked about between the respective heads to the team. And I think we'll take a year or two to create. Some backends have been made, but I think in 2 years' time, we'll look very different from what we are now. If we don't, then I think we'll lag behind by a decade or so. That's how fast this area is unfolding.
Got it. How is Mirae AMC planning to scale across B30 cities and beyond?
Yeah, very interesting, that question. And see, the challenge to every business, not to Mirae Asset, in the advent of AI is to how to build scale without adding people. That's the challenge to every industry. For the first time, the disruption is us human beings, right? And you don't try to fight this disruption. That's realization one. We are definitely one of the smallest manpower teams in the country, and we intend to stay that way. In 2011, I was asked, going back to the same interview, how long will it take for your entire country to know your product, was a question asked to me. In 2011, it looked like a question out of my syllabus. So I had asked, how long will it take in Korea? And the gentleman had said, half an hour. I said, how? I said, everybody has a phone. I realized then that this business was weird to the phone. So while we are there in 25, or say we will aspire to be in 30 cities, you will see not only us, but all businesses now doing business on the phone, right? Cosmetics are more bought in the smaller cities on the phone than they are. And that behavior will percolate. Today, the young are absolutely fearless, sharing their most personal data on ChatGPT. If that is the behavior, you think they will not extend that behavior to financial investing? If we are not acknowledging that we are in somebody else's world, and that investor will not come to us. But how do we build this tech backend is something which a manufacturer will build, not distribution. Distribution is a separate ballgame altogether. I firmly believe that Indians, being a little more emotional than the rest of the world, will transact digitally, but will do business physically. As we see financial advising taking a different shape and this route going more towards plans rather than the product, the penetration of distribution will start growing up faster than the need for. This is the only country where mutual funds have branch offices.
Oh, is it?
The only country. In Korea, mutual funds and banks are relegated to cafes. There is no need.
Okay.
Right? Because everything is on the phone.
Interesting.
That is where it will go in the next. I think the young of India will take it faster than we think. Right? Today, you check up any fund. I mean, as a fund, as an industry, we are ready to go online completely. But still, there is a small fraction of Indian investors which are necessarily doing paperwork. So, respecting that, we are still, some part of paper is still there. But pick up any fund houses, 70-80% of transactions are already digital, right?
Speaking of SIF, can you explain what this product is and for which investor class is this best suited for?
Yeah, first of all, it's a separate asset class or a separate fund category which is being launched by the industry. It is the specialized investment funds. And then at the outset, I'm extremely proud and happy that the regulator chose the mutual fund platform to launch this. Second most important is it is a product aimed at people with a higher risk profile than the existing mutual fund product. It's one step higher. So it is meant for people who are conversant with markets, who are probably invested in mutual funds for a long time or are conversant with products like the portfolio management service or the AIFs. It's for them. What advantage mutual funds have got is that the minimum amount size is just 10 lakhs. And secondly, it has the transaction ease of mutual funds, not the hefty paperwork that you have to do elsewhere. And third, most important part is the taxation is that of the mutual funds. It's a mutual fund with that risk profile.
Got it.
And the beginning of this industry or the beginning of the product, I would really like investors to look at the change in risk profile that they are getting into rather than the prospect of the products. When we start investing, we think it is a process of return generation. As we develop as investors, we realize that it's a process of risk mitigation. The closer the product is to our risk profile, the better the investment journey. And this is about risk profile.
Got it.
It enables funds to get into the derivative part of the market. Until now, mutual funds have not, invested to the derivative route. So that's a huge change from the fundamental structure of mutual funds. That's something which people must read a bit about. This is both on the equity and the debt side. Some people might say that, it gives you this ability of hedging the market, which is the benefit. It is not necessarily about returns. What it gives the fund manager, and I'll talk about our side of the story in that, it enables the fund house to express one's own finance or investment style far more liberally than it did on the mutual fund side. Because of categorization, the portfolios are more or less spelled out. But here, we can take our position as and when we desire to, right? It's expressing your own ability to the fullest. That's the best thing that could have happened to us. Then brings the main story. That means if there is a category called equity long short, 5 funds might express themselves in 5 different manners. So it is more to understand each fund's philosophy towards the approach, understanding what they stand for, rather than just looking at returns.
Wait.
I dare say what's happening in mutual fund industry is the flows are directly proportional to the last 1 year return. If that's the approach, it will not work in SIPs. It's getting a little deeper, understanding every fund's philosophy, understanding each fund management team's outlook towards that product. So I would take a pause here right now and just leave it at that, because that's a discussion every investor needs to have with his advisor, distributor, in understanding the fund philosophy before investing. First, allocating to whatever is right there, and secondly, return should not be the top criteria when it's understanding it. It's an outcome.
You're
Right? And some funds might not actually take the derivative route, can be completely long in their approach, and nothing wrong with that, right? So it's a very exciting thing that's happening here. But since it's the beginning of that entire product journey by the industry, I would sincerely request everybody to understand the risk profile of that product before you start investing. Once you understand that, the way you can approach it will be far better than what is the ideal way of approaching it.
Right, got it. How do you think a working professional should approach investing? Should they dabble into direct stock investing, F&O, or they should restrict themselves for their larger part of the portfolio to mutual funds?
See, when 93% of people are losing money in F&O as per the regulator, then it is not investing, right? Investing and that are two different things, and you need skill to be there. If you have the skill, do it, nothing wrong. But I would definitely encourage the young to back themselves in selecting stocks. Nothing wrong with that. Use your common sense. Don't get too carried away by a lot that is happening, but use your own self or your own knowledge to figure out which company might do well in the next 8-10 years and invest a little bit in that. Once you see that you have the capability of doing over a period of time, why not? That's one path. But people who try it and fail should clear off that position and come to a fund manager.
Right.
Right? The sooner you realize that, better. Both sides. Good for you. Right? And when you are now coming to a fund manager, then don't become a fund manager over the fund manager. Right? Take that journey with the fund manager. A good fund manager over a period of time will deliver what he or she aspires for. But it's the same as investing in a stock. But please, because they are new investors, I would sincerely request that when you look at assessing a stock, the principles that you put there should be the principles you assess on the fund manager. But now think of it, if a fund manager were to look at a stock and say, no, let me wait for 4-year track record of this stock and then I will invest. I'm contradicting a lot that is being discussed in the market, but I'm just leaving it out there. Sometimes you have to back yourselves on selecting a fund manager. And if you get a fund manager early, a lot can change for your portfolio if you are doing it on your own. If you are not, there are enough professionals in the market. But there, when you start investing, first find out the reason why you want to invest. Even if somebody comes to me and says that, okay, I want to create wealth, define that wealth. Right? No, I want the best return. Fine. Define that return. Then you will know whether that return is feasible here, or from here I'll have to take an Uber and go to a place called Mahalakshmi Racecourse and involving horse trading or horse racing, whatever. Sometimes the returns are not feasible. Once you put that objectivity to your portfolio, finding where to invest is not the big deal. Don't make the product the king. Make the purpose the king. Then your investment journey is closer to your life, or it's about what you need from life. Ultimately, your portfolio should give you what you want for you to lead your life, right? And it is a reality that all of us are going to live longer. And at that age, you have only one friend, that is money. Don't underestimate the value of money in your life in today's world. So the sooner you start, the better, because you have this magic called compounding on, and don't underestimate the magic called compounding, right? The longer you stay, the better it is. Select a good manager, take the journey for the next 15 years. More important, you are sitting on a country which is set to double its economy in the next 8-10 years. One of the best ways of getting this double of the economy into your portfolio or your life is through the capital markets. And the only person who's going to enjoy that ride is somebody who sits in the market. Right? You ask any great promoter in this country, is this the best time of your stock? That promoter will not know. If you are going to expect a fund manager to know the best 15 days of that promoter, it's impossible. What the fund manager does is assess the promoter and takes the journey with the promoter. And in due course of time, the value gets unfolded to the portfolio, it comes to it. That's how simple it is. Keep it this simple, you're sitting in the best economy of the world at this moment. But if you're not invested, then it's your problem, not mine.
Last question from our side. Since our audience consists majorly of financial advisors, fee-only advisors, what is your recommendation to them when they're advising their clients?
Yeah, I think first, can we get down our bias to zero? It's impossible, but that's the first job. A good advisor is one who does not get his or her own risk profile to the client's risk profile. The client is a different risk profile, different need. I say this because when I see the market buying 45% of sales going to small cap, this is not existing. It's not everybody. I'm not against small cap. We run a very good small cap now, but can 45% of sales want a small cap? That's not the risk profile of the person. The average Indian in today, that's the RBI data I'm talking about, 10% is equity, full equity. 32% gold. Almost 30% bank FDs. While most advisors think mutual funds, they will not invest in debt because of taxation, the person is happily investing in bank FDs. It's a bias that I'm talking about.
Yeah.
The growth in an advisor cannot or can be that much by selling one asset class. It is about increasing wallet share. And successful advisors increase wallet share. If you haven't given gold in the last 10 years, then it's your mistake. Sooner you realize it and rectify it, better for you. The person who does merit to the client's portfolio can eat the cake, have it, whatever. That's where one is sitting on. Wealth is being created in this country at an individual level. It's probably the best time to be an advisor or distributor, right? But, I'll end by saying that in any person's or any investor's life, the star of the person's life is the goal of the portfolio. But the rock star is the person who takes that person to the goal. The advisor is the rock star. But to be a rock star, you have to be capable enough, right? Build those capabilities, because whatever growth you put in this country, you can be 10x of that in the next 8-10 years. That's the potential.
Got it. It was a really insightful conversation. It means a lot to us that you took out time and shared your insights. Thank you so much.
No, my absolute pleasure doing this. I'm a big fan. I read your publication every month, and whenever it comes in, thankfully I get it now. So it's what you're building is pretty special. But just continue this great work.
Thank you so much, sir. Means a lot.